Morning, everybody. My name is Emmanuel. There's not much space for me to walk around. Basically what I'm supposed to be talking about is market outlook, global trends. My other fellow esteemed speakers have gone at some length about investment horizons, investment behavior, and how you should be looking at a balanced portfolio. Professionally, I function as a foreign exchange strategist. But beyond that, when I look at the universe of currencies, I also have to look at the global factors. Most of the time, in fact, all the time, the global factors and the global influences have a bearing on how we undertake different investment recommendations, different views of the market. So let me take you through a couple of huge issues, biggies, if you want to call it, that will probably keep the markets quite transfixed over the next couple of years. Well, it runs from anywhere from 6 months to the next 1 year, 2 years, and so on. The other thing is, whenever I'm called upon to speak on the market outlook, it never seems that it's the right time, because typically we are right in the middle of something, right? We're right in the middle of a market crash, or somebody's hiking rates, or somebody defaulted. But anyway, that's what keeps me in my job. That's what makes the market very interesting. Let's just start. Typically when we look at the investment landscape, when we look at what should we do with our money, how should we allocate our resources, I think basically that's what everybody here wants to do, right? We always have to take a step back and look at the global environment. What kind of operating environment are we sitting in right now? Are global central banks raising interest rates? Are inflation rates running out of control? Is the global economy slowing? What's happening out there before we actually try to make an informed decision, right, with respect to our portfolios? Just some squiggly lines up there, but basically the environment we are sitting in right now is one where global growth has continued to be subdued and fairly moderate. We will see later why this creates some tension with what the US Federal Reserve is expected to do pretty much in 2 weeks' time. This has been going on for a while now. The global economy is slowing. We have all read about China. We have all seen the newspapers about China and what's been going on over the past couple of months, especially in the month of August. Right? That to us is a manifestation of what's been actually going on in the global economy itself. So first point today, we are actually sitting in an environment of an economic slowdown, right? Remember post-Lehman, that was in 2008, you had all the central banks actually cutting rates and going into quantitative easing, where basically, in a nutshell, the central banks just basically opened up the checkbooks and flooded the market with liquidity, right? End of last year, when global crude prices collapsed from $100 to $50, we had another concerted round of central bank easings in December and into January even. The global environment is at odds in terms of how the macro fundamentals are looking. On the one hand, you have a slowing global economy. Things have not really picked up with any conviction for a sustained period of time. Secondly, you have the whole suite of central banks furiously trying to provide liquidity to the markets, in an effort not to choke off any nascent signs of a recovery, right? Then you have what the market is now affectionately called, what the Fed is probably going to do on the 17th of September, which is the liftoff. When we started 2015, Okay, basically, all of us at the banks would be basically looking at the whole investment horizon, the whole investment landscape. You start the year and say, okay, what's our game plan this year? Right? How is the environment looking? Where is inflation going? Where is growth going? Where's the money? Where are the investment funds going? Okay. The working assumption was the Fed will probably initiate a lift-off. Okay. What do we mean by the lift-off? Okay, remember post-Lehman, everybody cut interest rates, and we all went into massive liquidity story, right? Bar none, all the central banks on a global scale. This was the year 2015. This was the year when things were about to change, and it's probably going to change, right? The Fed essentially let the cycle down in terms of rate cuts and providing liquidity. 2015 was the year where the Fed would actually stop its QE and basically initiate a rate hike. So imagine, if you will, we have been living for the past, since 2008, 8 years, in an environment of surplus liquidity, in an environment of where growth is a little bit moribund, in an environment where you had inflation cycles running a couple of times up and down and up and down. The problem is, right now, where the tension in the market is you have slowing economy, you have crude prices, again, feeling a little bit weak, right? Because we are basically oscillating at about 30, 40, about low 30s a couple of weeks back. But anyway, we are off the highs in summer when oil was about $60 a barrel. Okay, so we are probably now at about 40, 45. Okay, the danger to market participants is when the Fed initiates the liftoff, it sends a signal to the market that, hey, the US economy is looking fairly okay. And in the US Federal Reserve's eyes, the marginal utility of additional quantitative easing, or in our terms, basically excess liquidity, is probably dropped a fair amount. So it's probably time for them to try to initiate the liftoff. Then you look over your shoulder. Wait a minute, China just went through a whole lot of market volatility. Let's put it gently. Global economy is still struggling, trying to get back on its feet. What's actually going on here? What is it going to do to our rates? What is it going to do to equities? How would this actually impact market participants? Where would the investable funds actually flow to? What's this? Okay. Here's the reality, right? Pretty much from late 2014 and pretty much going into most of 2015 this year, investor behavior on a global scale had been very apprehensive towards emerging markets. Okay, who remembers the acronym BRICS: Brazil, Russia, India, China? Right, that term was coined a few years back. And at that point in time, post-Lehman, you had this whole belief that you had the G4 economies actually slowing because of Lehman and all the attendant fallouts from the PIGS, right? So the gauntlet actually fell onto the emerging market economies. Don't worry, everybody said. We will have China, we will have Brazil, we have India, we will have Russia, and this will continue to underpin growth. So emerging markets will continue to be a fairly attractive proposition. Here's the hitch. When the BRICS actually started to decelerate sometime mid to the latter part of 2014, they haven't stopped all the way into where we are standing right now in 2015. You again had market tensions. What we actually witnessed was that flows into emerging market bonds and equities were quickly losing their appetite, right? In terms of where investors would actually be trying to park their money, you had an environment of low interest rates, right? Inflation wasn't going anywhere after a while. Growth was slowing, so you had basically funds looking for yield. Okay, this boils back down to market behavior in any given cycle, yield-seeking behavior, right? You have an environment of fairly low, stable interest rates outside of the Fed, of course, given the expectations about the imminent liftoff. You had growth that was probably not going to fall off a cliff. Okay, where would the money go? The money would actually, and what has actually transpired is that the money actually sought out emerging market bonds, high yield bonds. And we'll see in, it's actually not in this slide, but you'll see in the last slide, okay, a large part of the portfolio allocation went to bonds, right? Because it's very basic. It's basic investment math. Where is your expected rate of return? And this is where your funds would actually flow to. Here's the problem. Now you have a Fed that's probably, we think, actually in our view, initiate the liftoff in about 2 weeks' time. Then you have China. What happened over there? Right? Okay, this whole China issue could be another 3-day seminar, but let me try and condense everything. Okay, China had been and has been struggling with a growth slowdown, but it's partly also on the back of an attempted restructuring of the economy. Okay, so no big deal there. The problem was you had an intermediation process that was, shall we say, not 100% functional. You had an equity run-up that was actually also underpinning the rest of the global markets, because essentially when you had the Shanghai Composite just going from height to height, you had a market that actually felt pretty good about themselves, right? And then you had the Chinese authorities basically trying to coach and trying to actually initiate a structural change in their foreign exchange regime. Okay, this all goes back down to their intended inclusion in the IMF's SDR basket, so on and so forth. Okay, so it's all a byproduct of an attempted structural change, which is all good. Okay, what do we run into in 2015? You had China trying to initiate piecemeal monetary accommodations. They cut the lending rate, then they cut the deposit rate, then they cut the reserve requirement ratio. That didn't work. Let's cut all three at the same time. I'm not joking here. They did that when they cut everything 2 weeks after the deval of the renminbi. Then your next question will be, what's going on with the renminbi? Okay, I think it's very important that we take a step back and we try not to be alarmed. Okay, in our view, it was part of a structural move and an attempt by the Chinese authorities to actually let the renminbi be a little bit more reflective of the underlying fundamentals. Okay, this was especially so when we actually saw a little bit of a divergence between what market perceived as an approximation of fair value and what the broad valuation of the renminbi was going to be. Unfortunately, over the summer when we had a little bit of market volatility, they kept it stable. Okay, long story short, that actually pushed up the broad valuation of the renminbi. So, in an attempt, we think, to actually bring it closer to market valuation, market approximation of fair valuation of renminbi, they actually devalued the renminbi over the course of about 2-3 days. Okay, let's cut to the chase. Your next question will be, so where's the renminbi going? Okay. The philosophy has changed. Okay, they have been moving rapidly towards a market-driven mechanism across all markets: FX, interest rates, equities, I guess. In an attempt to actually let the market, okay, listen to my words carefully. In an attempt to let the market actually try to sway and form the fair valuation of the renminbi, they will, we think, in our view, let the value of the renminbi is still set onshore every day by the central bank, the PBOC, right? But in time, I think there will be more flexibility. Okay, the kicker here is that gone are the days when you would actually expect, this is especially if you look back the last couple of years, 3 years in fact, 4 years. Gone are the days where you would expect a linear, uninterrupted trend of renminbi appreciation. Okay? Put that out of your mind. Okay? That's not going to happen anymore. Okay? The implication is that when you have the Fed actually lifting off, if not September, then December, right? The implicit assumption by the market is that the dollar will start to strengthen. Okay? If the dollar starts to strengthen, think about where your current environment is. You have a weak global economy, you have inflation that's going nowhere, you have growth that is continuing to slow, you have China that is attempting to impart more market-driven dynamics to its exchange rate. Where do you think the renminbi will go if the dollar strengthens against its major counterparts? Right? That's one. Secondly, we would have to be very aware of the implications on the other asset classes. Okay? A lot of commentators out there, well, not a lot, but enough, actually blame China for this whole market volatility since August, when we had the deval, and well, prior to that you had the turmoil in their equity market. Okay, in our view, it just provided a catalyst. Okay, in our reckoning, by June, July, when we looked across all asset classes, okay, well, of course with the background of the macro indicators, cyclical currencies were not behaving very well. Okay, the global economic indicators were continuing to slow. Credit spreads were blowing out. What I mean is that premiums that investors were actually demanding to hold, for example, emerging market bonds or emerging market high yield bonds, were actually going wider, which means that the risk implied was actually widening. Okay, so all the danger signals were there. At that point in time, our view was that the equity market on a global scale was high as a kite. But, well, if nobody was going to rock the boat, let's just go with it. Right? So I think what has happened over the past 4 weeks, 6 weeks, is probably a minor hiccup. That's probably not going to affect your long-term horizon. In our view, it's basically a repricing of the global economic macro backdrop. Okay, in terms of where investors would put their money, whether be it in emerging market bonds, high yield bonds, would it put it in treasuries? In our context, would you put it in SGS? If you choose to look at FX as an asset class, would you put your money in some other currencies outside of the Sing? Right? So a lot of the investment decisions would have to pull from all these factors surrounding you. Okay, so I guess my time is almost up. So going ahead, let me come back to where I started. Where are we? Where are we at? Right? This is the question we always ask ourselves. Be it at the beginning of a quarter, beginning of the year. Where are we at? What are we going to do? Okay? 1. Growth is still slowing. Okay? This is compounded by fall in commodity oil prices. Watch out for an eventuality where you have central banks actually moving in the opposite direction even more than currently, compared to where the US Federal Reserve is going to be headed over the next 12 to 24 months. Okay? That will continue to create tension. Secondly, and the macro guys say this every year, let's hope China continues to stabilize, okay, over the next 6 months, 12 months. Okay? That story has been told since middle of last year. It hasn't really panned out. Okay? Make no mistake, we still think that China has the financial resources to actually hold it together. We don't expect a meltdown. But do be on the lookout for volatility. Okay? And how that would actually spread out to the other asset markets, geographically as well as across different asset classes. the last bit is, of course, your volatility. Okay, it comes back down to a very, very structural question. This is the first time since Lehman when a major central bank, US Federal Reserve no less, will actually make a U-turn and start to hike interest rates. Okay, so you can see where the tension is going to be generated. You are going to have the US Federal Reserve basically trying to normalize interest rates, okay? Quote unquote, normalize interest rates. They're not trying to tighten policy. But look at where all the other central banks are going. Okay, the European Central Bank, the ECB, is only slated to finish its quantitative easing in September 2016. Latest word from 2 days ago is that they may do more if the situation doesn't improve by September 2016. The Bank of Japan is is expected to only end its QQE, its quantitative easing program also, sometime in 2016. Okay. All these plans had been basically laid out 1-2 years ago, if not last year, 1-2 years ago. Things have not improved enough for the central banks to be actually falling in line with the US Federal Reserve. Okay, so what we call in the markets a policy dichotomy. This policy divergence will continue to create a lot of uncertainty. The fact that the US Federal Reserve is actually going to hike interest rates and in due course also start to look at shrinking its balance sheet means for investors with an investment horizon beyond 6 months, 12 months, your global liquidity picture is going to change, right? It's not post-Lehman, it's not an environment where you have surfeit of global liquidity and investment funds will continue to slosh around, search for yields, and you get a lot of momentum. Okay, your global liquidity pool is going to start to shrink over the next 2 to 3 years. Right? This is where your volatility will start to go higher. One thing we have to do is basically shake ourselves out of this haze. Okay, the old days are over. Just be very, very conscious on that part. We will probably return back to pre-Lehman days, okay, in terms of market liquidity. Well, let's not even talk about financial regulation and all that. The point is that the global pool of global liquidity will start to shrink, okay, in terms of investable funds, in terms of the speed at which markets will actually move. Simply because by 2016, 2017, hopefully if everything goes right, most of your central banks will be starting to normalize monetary policy. Okay? So it's not going to be everything ends well and everything is la-di-da and we are in a stable interest rate environment. Okay? Think ahead. 12 months, 24 months, 36 months. Okay, if we actually start to pull out of this economic cycle, this whole malaise that's been afflicting global markets for the last 12, 24, 36 months, inflation will start to climb. Right? This will have implications on your portfolio diversification. Central banks will start to tighten. Okay? God knows where the dollar will be by then, but our view is basically over the next 12 months, the risk reward is weighted in terms of being in favor of the US dollar against a whole mass of currencies. Okay? So I guess the takeaway is just forget about the last 7 to 8 years. Okay? Going out ahead, it's going to be a different ballgame. And we have been actually waiting for this day. The markets have been agonizing for this day. Okay, for when things will return to some degree of normalcy. When the US Federal Reserve hopefully will be joined by the other central banks in the next year and a half, I guess. A year and a half. So just be very careful on that aspect. Okay, let me end off with my last slide. There's actually an interim slide that I didn't include. Okay, when I was asked to speak at this event, I had to look across all asset classes. Right? Typically, I mean, we've had a whole morning of good investment advice. Typically, you will want to look at bonds, you want to look at equities, you want to look at commodities. Okay, this is what transpired and what has been going on. 12-month return in terms of if you had used FX as an asset class, if you had used if you had invested in emerging market equities, if you had invested in emerging market bonds, or even treasuries, okay, then you had year-to-date return, which is the graph on the right. Okay, this was about, I don't know, 2 weeks after the deval, and the Chinese market was still trying to, let's just put it nicely, just still trying to recover. Okay, this comes back to my point. Okay, your investment horizon is important. Your volatility is going to, let's put it nicely, be a little bit higher compared to the last few years. Okay, because you have Chinese deval, you have Chinese equity volatility that subsequently impacted global markets, okay, across all emerging market asset classes. And this is what happened to your rate of return year to date. Okay, so I think this is a very good reminder, okay, of how the global investment climate is going to change. There's a graph that's actually missing. It's actually exactly the same thing, but what I actually charted was the year-to-date return before the renminbi deval and the Chinese equity turmoil. Okay, the picture was very telling. Okay, there was search for yield. Your highest yielding asset class was emerging market high yield bonds. That's what the whole industry has been actually been geared to over the last 1 to 2 years. You had this whole investment rationale that EM markets will continue to outperform. You had basically EM equities continuing to outperform. Okay, there's no free lunch in the financial market. When you basically go down the credit curve in terms of emerging market high yield bonds, emerging market equities, when the volatility hits, okay, my best advice is do be prepared for the drawdown, for the volatility to actually have an impact on your portfolio itself. Okay, if there's any takeaway from today, I think basically the volatility has returned. And just try to forget the last few years, okay, when you had very low vols and a lot of excess liquidity sloshing around. That's going to change in the next 2 to 3 years. All right, thanks a lot.